Welcome to Avalara Presents, Reading Between the Lines, Tax Jurisdictions and the Way They Divide Us. My name is Erin Wiggins. I'm the team lead of U.S. Rates and Boundaries for Avalara. The main theme behind this presentation is how location-based complexity can affect your business's ability to be sales tax compliant. This particular focus on location and geospatial information is rooted in my own educational and career backgrounds. I went to the University of Washington and I graduated with a specialization in Geographic Information Systems, or GIS. This particular focus has been the focus and hallmark of my professional career ever since. I started out professionally at a small private mapping company based in Seattle called Integral GIS. A lot of the things I did there were focused on environmental and energy applications. Little did I know that I would become an expert in sales tax because of this particular GIS focus. I started at Avalara over 2 years ago, just when the company was developing a proprietary spatial assignment application. This application maps tax district boundaries and then matches them to their sales and use tax rates. I am responsible for maintaining the accuracy of all of these jurisdiction boundaries and rates across the entire country. This requires research as well as implementing all changes into our system. From this experience, I've gained thorough knowledge of all states, especially the ones that are very complicated. Additionally, I resolve customer issues related to the addresses they sell to. So if they are curious or they have an inquiry or they disagree with the jurisdictions we return for a particular transaction, I do the research and I determine whether or not our service was correct. More often than not, it's just so convoluted and confusing that there's just incorrect expectations on the customer side. The three things I hope you walk away with from this presentation are, firstly, to know exactly where your sales occur. You need to know your origin and destination addresses, especially if they occur in a state that has local rates. Secondly, you need to know the taxing authority for each jurisdiction your sales occur in. These taxing authorities can audit you, and they're also the entities that you remit all sales tax that you charge and collect. Lastly, incorporating all possible changes, whether it be rates, boundaries, product taxability rules, or return forms, any of those things. It's a very, very manual process. So automation in this particular industry is absolutely your friend, especially if you operate in more than one state. So today we'll start off by explaining the difference between a tax jurisdiction and a tax region, and then other relevant definitions to this particular presentation. After that, we'll move on to local option taxes and enactments and how you as a taxpayer can track them. Then we'll move on to taxpayer resources. So what kind of resources do you have available to you to make sure that you're staying on top of all changes? Then I'll go into a more granular description of special tax jurisdictions and how they vary by state. And now that you have all of this information, it's time to take a step back and look at the full picture. Having all this information, how do you now know to run a sales tax compliant business? We'll end with important takeaways and then do a Q&A session. Taxing jurisdictions versus tax regions. The basic difference is a tax region is a unique composition of tax jurisdictions. I'll give you an example. Santa Monica, California. Santa Monica is both a tax region and a tax jurisdiction. The tax region of Santa Monica, is comprised of the State of California jurisdiction, the City of Santa Monica jurisdiction, the Los Angeles County jurisdiction, and the Los Angeles County Transportation Commission, which is a special tax jurisdiction, and all of them together comprise that particular tax region. When I first started, it was easier for me to think of the difference as jurisdictions are the parts and the tax region is the whole. So to take that to a more visual level, think of a 7-layer bean dip. Every layer is its own tax jurisdiction, and the dip itself is the tax region as a whole. This differentiation is important for understanding the basics of sales tax in the U.S. because the more jurisdictions that you have in a tax region, the more complicated, accurate calculation and filing can become for you. Important definitions: taxing authority, administrative authority, and tax administrator. These terms can be used interchangeably. They all refer to the entities that are responsible for managing tax collection and revenue, as well as business compliance within the jurisdictions they administer. A majority of states have just one administrative authority, which is the State Department of Revenue or Finance. There are other kinds, which we'll cover in a moment. Reporting code, state assigned code, location code, and city-county code. Again, these can generally be used interchangeably, but different states use only one specific term for this idea or concept. For states that have local option taxes, which means that they have local rates aside from just the flat state rate, the administrators assign a unique code to these tax regions or jurisdictions. There's no convention in the format of these codes. They vary by taxing authority. Essentially, they're used in the return filing process. So rather than spell out the jurisdiction name on the return form, the codes are used to, they match up to the jurisdictions they're associated with. It just makes it easier on the taxing administrator. Nexus has been interpreted in many ways by many different taxing entities. It's because it's loosely defined as physical presence, and physical presence can mean a number of different things. It can mean you have a warehouse. It can mean you have an employee based in that state or jurisdiction. You can have a storefront. You can have a couple of trade shows there a year. Every taxing administrator has its own definition of nexus, and Amazon can tell you all about that. Once nexus is established, as the taxpayer, you're required to comply with that jurisdiction's administrative authority. Home rule refers to local jurisdictions that administer their own tax. They're also called self-administered. It's only legal in a handful of states. I'm going to list them all out because they're very important to you as a taxpayer. There's only 6: Alabama, Arizona, Alaska, Colorado, Idaho, and Louisiana. These states, or the home rules within these states, are responsible for all steps in the sequence of tax administration. They can create their own taxability rules, rates, return forms, anything. I'm going to get a little bit more granular and explain the difference between each of these states and how home rules work within them. In Alaska, there are over 100 home rule cities and a handful of home rule boroughs. Boroughs are equivalent to counties. There is no state rate for Alaska. Any local rates, though, are applicable, and every local rate is home rule. In Alabama, there are over 50 home rule cities and counties. Arizona has over 10 home rule cities. Colorado has around 80 cities that are home rule. Idaho has less than 10 cities, lowest number by far. And Louisiana, each parish, which again is equivalent to county, is home rule. So the state in Louisiana does not administer any local tax anywhere. Return form. This refers to the seller's use, and consumers use tax return forms that are due to tax administrators. Depending on the taxing authority you operate in, each of these 3 different tax types can have its own return form, which just makes it more complicated for you as a taxpayer. All sales occurring in any of these jurisdictions must be reported on these forms and sent on time to their respective administrators according to their specific filing frequency requirements. So this can be monthly, quarterly, semi-annual, or annual. Interstate versus intrastate. Inter means between, so from one state to another. An example of this would be from Seattle, Washington to Detroit. Intrastate means within, so within a state, from Seattle, Washington to Spokane, Washington. STJ, this is going to be one of the most recurrent terms you hear throughout this presentation. Special tax jurisdiction. It's a unique tax district. It's separate from city and county districts, and they exist in a variety of states. They complicate the taxpayer compliance landscape to a large degree. Local option enactments. Start out with some fun facts. In 2012, over 60 cities and counties enacted a local tax in over 16 states, and these states are spread over across the country. In Nebraska alone, on October 1st, 2012, there are 7 new city sales and use tax rates. All of a sudden, if a city that you've been selling into in Nebraska enacts a local tax, if you don't keep track of that, then you are then undercharging and you're at risk as a business for audit by the state. So start out with process of elimination. Where won't a local option enactment happen? There are 4 states in particular that you will never ever experience until they decide to change their sales tax legislation, but they don't have any state or local sales tax rates. Those states are Montana, Oregon, New Hampshire, and Delaware. As a consumer, you might already know this because it's more enticing to shop in a zero-rated sales tax state than one that can have a composite rate locally of over 10%. And then you have your single-rate states, of which there are quite a few. They include Kentucky, Maine, Maryland, Michigan, New Jersey, DC, Rhode Island, and many more. They tend to be on the eastern half of the U.S. So where do local option enactments happen? Firstly, they can occur on a monthly, quarterly, semi-annual, or annual basis. And I'll go through an example of each time frame. Monthly enactments and changes only happen in states that have home rule localities. So again, those states are Alaska, Arizona, Alabama, Louisiana, Colorado, and Idaho. States that make quarterly changes and enactments, which is the majority of states that have local options, include Missouri, Texas, Kansas, Washington, Oklahoma, California, Nebraska, South Dakota, and so on. Semi-annual states, there are only 2, Illinois and New Mexico. If Illinois misses something, they will submit an amended change schedule, and you as a taxpayer are expected to keep up on that late posting. Lastly, the only annual state that sticks to that particular schedule is Florida. So how do you know if an enactment is going to happen very close to home to you? You usually actually have the option of voting. For the most part, balloting and voter approval is required for any rate changes or enactments to happen. So I'm going to give you a few examples. In Louisiana, voter approval is required. Balloting usually occurs during the spring and fall primaries. However, the rate change can be part of a different ballot initiative more than twice a year. So there's not really a systematic way of keeping track. In Alabama, it gets a little more complicated depending on the city you're in. Any changes depend on city council votes as opposed to public votes. And other cities require voter approval. And lastly, in Missouri, Illinois, and Kansas, city and county changes and enactments do require voter approval, but for special tax jurisdictions, those are approved outside of the public. Taxpayer resources. What do you have available to you as a taxpayer to keep track of all of these changes all across the country? There are 3 different types of tax administrators: state, home rule, and third party. Department of Revenues. Generally at the state level, they're called different things. California has Board of Equalization. I believe New Mexico is Department of Finance. But every one of them has a website. Not all of them are very easy to navigate, so I recommend becoming familiar with those websites to know when a rate change is going to be posted and how to locate that on their website. They do post these rate change notices, and they also provide rate schedules, which are known as rate tables as well. These are a list of every tax jurisdiction and their rates. They're very useful, but they can only be used correctly if the taxpayer knows exactly where their address is located. For example, if a sale is made to an address that uses Santa Monica as the city name, there's no guarantee the address is located in city limits. If it isn't located in city limits, it's in unincorporated county, but the taxpayer assumes that it is, they'll look at the rate schedule and they'll charge the higher city rate even though it's not applicable. So just be aware that this is a list of jurisdictions and their rates. It's not an equal to based on address. Home rule cities and counties, the only reliable source of information is the jurisdiction itself. Doesn't matter what the inquiry is, if it's for planned rate changes, the current sales use tax return form, call up the home rule city itself or county, whatever it may be. In some cases they do have websites, but they're not always regularly maintained and updated, so it's really good practice for you to communicate directly by phone with those specific places. Then you have third-party sales and use tax administrators. These administer tax collection and compliance at the local level for one or more jurisdictions. Sometimes they operate in multiple states. Each of these administrators maintains their own rate schedule, return form, rate change notices, filing frequencies, everything. For all of that, they take in a percentage of the revenue generated, and for the most part, these third-party administrators do pretty well for themselves as businesses. They're quite successful. Taxpayer support lines are always valuable resources to you as a taxpayer. If it's home rule, again, call up the city or county itself. They will have a finance administration or department if they are responsible for tax collection. And Department of Revenues, you'll probably have to wait a little bit longer because there's a higher volume of calls since they administer a higher volume of cities. But generally, the best way to know exactly what's going on in a place you do business is to call up the tax administrator, wherever that is. Another valuable resource that some states provide to you as a taxpayer is an online address-based rate calculator. States that provide this include Texas, Washington, Oklahoma, Kansas, Colorado, South Dakota, and they are very valuable. They help you as a taxpayer determine how much to collect and where to remit, but they aren't based on origin and destination addresses, so they aren't necessarily always 100% accurate. I myself have had to contact Texas and South Dakota as well as other states to correct the information returned for a specific address and their rate calculator. Lastly, you have mailing lists. You can sign up depending if the Department of Revenue or whatever taxing authority you're operating in, if they provide this, essentially you sign up and you're on a distribution list. So either by mail or email, you'll receive any updates that may affect you as a business. These are very useful. They help reduce the burden on you as a taxpayer, but a scheduled enactment, increase or decrease, is always subject to change until it becomes effective. So keep on top of it. STJs, or special tax jurisdictions. So what exactly are they? There are a variety of different kinds, and in the most situations, they're unique to the states they live in. But generally, they're created to focus sales tax revenue on specific public or government projects. So, for example, many states have transportation-related STJs. All revenue generated from the extra sales and use tax rate is dedicated specifically to maintaining and improving either public transportation systems, infrastructure, road quality, and so on. Another example is South Carolina has school districts, so the extra revenue generated in those counties that have school districts is then distributed to education. STJs are created independently from composite local rates so that funds can be managed accordingly. So for the most part, STJs actually have their own state-assigned codes that taxpayers must use when reporting their sales and filing their sales and use tax returns. Those codes then allow tax authorities to allocate revenue where it's been committed to. The other primary places where STJs exist are in tribal jurisdictions in states like South Carolina, Utah, South Dakota, etc. Generally speaking, these STJs follow the tribe's boundaries. Because tribal jurisdictions are self-governed, they're subject to different sales tax laws, and they have agreements with the states they reside in that are unique to each tribe and state. And lastly, you have county level versus city level STJs. This definition is pretty self-evident. If an STJ resides in the county, it's county level. If it's confined to city limits, it's city level. An STJ can be both. Missouri and Texas are notorious for having STJs that are both county and city level. So the screenshot here is from the Texas Comptroller's Office. It is a description of one of the new STJs that became effective on October 1st, 2012. As you can see, they give you the code they expect on the return form, the new rate, what the name of the special purpose district is. They also give a boundary description and a phone number to call. So if you think that perhaps one of your sales occurs in this new STJ, you can call up the STJ representative and they will tell you whether or not your sale occurs within that jurisdiction. It's actually very transparent. Texas is one of the best states in terms of making it transparent to you as a taxpayer whether or not your sale occurs in one of these special jurisdictions. So just taking a second here, I know this is a lot of information to consume. All of my notes are available on each slide for anyone to reference afterwards. My contact information is on the first slide, so please contact me with any questions or clarifications. I'm about to get a little more granular into STJs and how they vary by state. We'll try and get the hardest ones over with first. Alabama. Alabama has police jurisdictions, or PJs. So if you take a look at this picture, you can see the kind of donut-shaped jurisdictions. Those are the police jurisdictions. They are unique to Alabama. Essentially, they're an agreement between the local police and emergency services with the citizens in the county just outside these city limits. So for a slightly higher sales tax rate than if they were in just unincorporated county, but a lower rate than if they resided in city limits, the police department that is subject to just addresses located in city limits will expand their jurisdiction to include these PJs. So you're paying a slightly higher sales tax rate to get these extra services. How do these work exactly? Police jurisdiction rates are half of the rate of their city. So for example, Mobile, Alabama has a 5% sales and use tax rate. Its PJ likewise has a 2.5% sales and use tax rate. If Mobile only levied a sales tax rate and no consumer's use or seller's use rate, likewise its PJ would only levy the sales tax rate, no other kind of use tax rate. Their boundaries are very unique. The size of it depends on the population size of the city it's associated with. If you have a population over 6,000, then your PJ for the city will take on a 3-mile radius around the city. If the population is under 6,000, the PJ radius around the city will only be 1.5 miles. PJ rates, just like other places in Alabama, every jurisdiction in Alabama, in fact, can change or enact on a monthly basis. So if you do business in Alabama, changes happen all the time. Staying on top of that becomes that much more onerous. PJs are administered by the same authority as the city they're associated with. So if Mobile, Alabama is home rule, likewise its PJ will be administered by the city of Mobile. Moving on to the Midwest, Missouri specifically. Missouri is, in my opinion, one of the most complicated states because even though it's state administered, The state does not provide any address level or boundary information for any of its SDJs, and it also has one of the highest volume of SDJs of any state in the country. There is no limit to the number of SDJs that can overlap or that can exist in a city or in a county, and their boundaries are very complicated, especially the ones that are county level. There are 4 different kinds of SDJs in Missouri: Transportation Development Districts, or TDDs, Ambulance Districts, Fire Protection Districts, or FPDs, and Community Improvement Districts, or CIDs. CIDs and TDDs are mostly confined to city limits, but there are exceptions, as always, and they can reside in just the county. However, ambulance districts and fire protection districts are always residing in some part of the county. Give you an example of complexity, as you can see on the screenshot here. This one tax region in the city of Springfield, Missouri, has 4 STJs in less than a block radius. As you can see, it's just one stretch of a block, but it doesn't contain everything within that block. Those STJs are Downtown Springfield CID, College Station CID, Here's Tower CID, and the Here's Tower TDD. Just in that area that's shaded purple is that specific tax region. Right next to it, you have a pink tax region, which is its own unique composition of taxing jurisdictions. And to the left, you have that olive green tax region that is comprised of its own unique jurisdictions. So you have 5 different tax regions in this literally 6x6 block radius within the city of Springfield. That's how complicated tax compliance is within Missouri. So not only are there really complex tax regions, they're everywhere. In St. Louis, there are over 50 SDJs. In Kansas City, there are over 30. In Columbia, there are over 15. So it's one of the most difficult states, not only because of how complex it is, but because they are very untransparent to you as a taxpayer. It's almost impossible to determine which jurisdictions your sale occurs in. Okay, breathe. This is easier. The rest of the Midwest that has STJs are Kansas and Illinois. Kansas has, like Missouri, transportation development districts and community improvement districts. They also have star bonds, which are unique to Kansas. There aren't any super complicated tax regions from an STJ perspective in Kansas. There's only one place in the whole state that I know of where there's any overlap, and Kansas doesn't have any county-wide or county-level STJs. There are also much fewer STJs in Kansas than Missouri. Just makes it much more simple as a taxpayer to do business there. Additionally, if there is an STJ, the Kansas Department of Revenue has a rate schedule that lists every single address that falls within an STJ. So that just gives you more information as a taxpayer to know for sure whether or not your sale occurs in one of these STJs. Star bonds are unique, and they're actually taxpayer friendly. They don't impose a higher local rate. They take on the local rate where they reside. So, for example, the Topeka Heartland Park Redevelopment District Star Bond has its own state-assigned code, and any sales that occur there use that specific code as opposed to the city of Topeka's code. This allows the state to distribute all revenue generated from that district to the public project it's been committed to, which in this case is the Topeka Heartland Park. And then you have Illinois, which only has business districts, again making the STJ landscape much less complicated than Missouri. Additionally, Illinois, which is state administered, provides an address list of every address that falls in their STJs, just like Kansas. There are much fewer STJs in Illinois and Kansas than in Missouri. And Illinois is semi-annual, so these new STJs, generally one's enacted every 6 months, but it's only every 6 months, whereas Kansas and Missouri can enact on a quarterly basis. So these 2 states, Missouri and Texas, account for almost every single STJ enactment every year. Texas. Texas, like these other 3 states, is self-administered. Texas is very unique. It is the only state in the country that has a maximum local rate of 8.25% for sales or use tax. With a state rate of 6.25%, this means that no local rates can exceed 2%. This local 2% can have a city, county, and STJ, or any variation of that combination, so long as that rate does not exceed 2%. Texas is, in my opinion, one of the most transparent states. Their website gives you a rate calculator. In my opinion, it's the best in the country. They also give you boundary information for every single special tax district. They give you contact information, and they also are very responsive when you send an inquiry to them for clarification. The reason why it's complicated is because they have so many different STJs, and they can also, like Missouri, have a large volume of STJs or local rates in one place. So I'll go through the different kinds of STJs quickly. Emergency services districts. These are probably the most prolific across Texas. Each county in Texas already has these districts, but only some of them have sales tax rates. They're always county level, but they can extend into city limits. Then you have CCDs, CCPDs, and FCDs, crime control districts, crime control and prevention districts, and fire control districts. These generally, well, actually, I think in every case, they take on the city boundary they're associated with. So if you know that your city has one of these districts, you know that you have to charge that extra STJ rate. And then you have mass transit authorities. These are generally located in the most populous areas around, say, Houston, Dallas, Texas, Fort Worth, San Antonio. They tend to be in very complex tax regions because they can be in unincorporated as well as incorporated areas. They can overlap with STJs. So, and with populations that are higher, you're going to have more complicated tax regions in Texas. Municipal development districts, for the most part, take on the city boundary they're associated with. At times, they do extend into unincorporated counties, so it's important to know exactly which MDD you might be selling into. And then you have economic development zones. These are, again, county level, but there's no rhyme or reason. They can cover large or small territories. You also have improvement districts, health services districts, assistance districts, library districts. There's just a ton of different kinds. But again, it's easier for you to just go to the Texas Comptroller's website, and they will pretty much give you all the information that you need as a taxpayer to be compliant in Texas. Washington. Washington rate calculation is unique for the most part. It's based on tax region, not jurisdiction. So what I mean by that, so as opposed to Texas, which we just went over, so you have the Texas rate of 6.25%. You can have up to however many local rates, so long as they don't exceed that 2%. Each one of those jurisdictions at the local level has a rate and a reporting code. That doesn't happen in Washington. In Washington, you have your state rate, and then you only have one local rate. Regardless of where you are, you're only going to have one local rate with one state assigned code to report to. The 4 different kinds of STJs in Washington are public transportation benefit areas, regional transit areas, hospital benefit zones, and transportation benefit areas. California is one of the more simple states in terms of STJ boundaries. They always, if the county has an STJ, it always matches the county boundary. So no matter where you are in that county, you're going to have to charge and collect and remit the STJ tax. So this is a screenshot from the Board of Equalization, which is the tax administrator for all of California. Their STJs are very specifically named. So as you can see in the screenshot, there is a Mendocino Library Special Transactions and Use Tax, Mariposa County Healthcare Transactions and Use Tax, So you as a taxpayer know where this revenue is being distributed to. California, with these extra STJs and local city rates, on top of a flat state and county rate of 7.25%, is one of the states in the country that has the highest composite local rates. Sports-related STJs. So Wisconsin has a baseball stadium district. It spans 4 counties, and they match those county boundaries. It also has a football stadium district in Brown County where Green Bay City is located. Go Packers. Wisconsin is generally an easier state in terms of boundaries and rates. It only has county tax, and it only has these STJs on top of that. There are no local city rates or municipality rates. Then you have Colorado, which did have a football district up until the beginning of this year, but it still has a variety of STJs across the state, majority of which are transportation related. The last kind of STJ that we're going to talk about is for tribal jurisdictions. Just to give you an idea of the complexity of these, one particular tribal jurisdiction, the Navajo Nation, is in Arizona, New Mexico, Colorado, and Utah. A majority is in Arizona, but portions do extend into those 3 other states, and the portions within those states have different agreements with those states. South Dakota. There are 4 Indian tribes in South Dakota that have tax collection agreements with the state. All businesses within these tribal jurisdictions are responsible for collecting and remitting tax at a rate of 4%. All tax collected in one of these tribal jurisdictions is reported on the state tax return using the code assigned to that specific STJ. The tax remitted is then distributed between the state and the tribal governments based on their tax collection agreements. That's actually one of the more simple, non-ambiguous examples of the relationship between a tribal jurisdiction and the state it resides in, as far as tax compliance goes. New Mexico has at least 20 pueblos. New Mexico is very unique. Each one of these pueblos has 2 tax regions that has their own unique state-assigned code. If it's tax region number 1, that represents sales to tribal entities or members. Tax region 2 applies to tribal non-members by tribal non-members. How you as a taxpayer are supposed to know if you're selling to a tribal member or non-member, that just complicates tax compliance in those particular areas to the nth degree. And lastly, you have, for this example today, Arizona. It does have fewer tribal jurisdictions than New Mexico, but their laws regarding tax collection in these areas are very ambiguous. There are different agreements with different tribes, so there doesn't, like South Dakota, or unlike South Dakota, there is no consistency there. So, for example, in parts of the Navajo Nation, as a taxpayer, regardless of being tribal member or non-member, you may have to pay for the state rate, county rate, as well as the tribal rate. And in some cases, that can amount to over 13% composite rate for just one location. In other places, for other tribal jurisdictions in Arizona, you only have to pay the tribal rate if you are a tribal member. So we've talked a lot about very unique situations across the country for SDJs. It's a lot to consume, but again, you can look at these notes afterwards. This is not a comprehensive list of every single type of SDJ in the U.S., but I hope you understand how much these SDJs, their complicated boundaries, and how non-transparent they can be to you as a taxpayer, how hard it makes for you to be compliant as a business. So now that you have all this information, how can you possibly stay compliant? What are the main things that you as a business need to keep in mind? Firstly, you need to know the sourcing of the state you do business in. For example, Illinois, Pennsylvania, and Ohio are origin-based states. So for intrastate sales, which again means within the state, within those states, the origin tax region is the applicable one to apply for that sale. California and Texas mix it up a little bit, and they have mixed sourcing. So for those intrastate transactions, deciding which jurisdictions are applicable becomes more complicated because you may actually have to collect local rates at both origin and destination tax regions. You have to know, and I cannot stress this enough, the physical locations of your sales. If you don't know exactly where your sale occurs, you risk miscalculation and therefore incorrect remittance. The audit risk for you is greater if you undercollect. So if you believe the address is outside city limits and you charge accordingly, the extra local tax will be omitted, and this can send a red flag to a state auditor. But on the other hand, taking the conservative approach poses an equal threat. You can lose your customer base. If you play it safe and you charge local tax when you aren't sure, your customers have reason to find a competitor that won't overcharge them. Lastly, you need to know how to remit to the correct administrative authority with the correct reporting information using the correct form. In certain states, this becomes very, very complicated. Alabama is a great example. In Alabama, there are up to 60 different sales or use tax return forms for all of the various taxing authorities. This doesn't include different tax types, which means sales, seller's use, and consumer's use. So for example, if you make a business sale in Mobile, Alabama, as these screenshots show, there are 3 different taxing authorities that you need to remit to. The state of Alabama, the city of Mobile, which is home rule, and the third-party administrator, RDS, or Revenue Discovery Systems, which is the tax administrator for Lee County, where Mobile resides. For authorities that require you to report based on location code, you need to make sure you have the correct code for the correct location you sell into. Also, states will have their own return form that is separate from the one for sales tax. They can have a consumer's use tax return form or a seller's use tax return form. Key takeaways. Boundaries matter. This is my main gig on a top of a much higher annual number of rate increases and decreases to existing jurisdictions. There are generally around 100 new STJ city and county enactments every year across the whole country. On top of the thousands of existing STJs across the country, it's very difficult to determine if your sale occurs in one of these places. Their boundaries aren't transparent. On top of this, city boundaries are constantly in flux. So determining whether or not your sale occurs in an STJ or in city limits is very difficult. Next, sales tax compliance requires taxpayers to pay attention to factors other than just boundaries. You need to be aware of changes to rates, taxability rules, the return form that you need to file to remit. You have to do your due diligence to track these changes, or else you risk audit exposure and or loss of your customer base. Lastly, I hope I've effectively communicated that sales tax compliance in the U.S. is exceptionally complicated, and the onus is completely on you as a business. And the more states that you do business in, the more onerous that is. There is no taxing authority that operates in the same way as another. All of this is so manual if you have to do it on your own. It is highly recommended. I am a guide. I know this industry. If you have an automated solution, highly recommend looking into it. It's a requirement for your business, and it can be just as easily outsourced as payroll. So I hope you've all learned a lot about local sales tax in the U.S., and that's all. Please feel free to contact me with any questions or clarifications. Thank you.